So good evening, everybody. It's Pamela Simons from WorkPlay Toronto and from PamelaSimons.ca. So I know that we skipped a Tuesday. So tonight's session of the WorkPlay Toronto show is going to be featuring investment properties. This recording, by the way, will be posted afterwards on some social channels, so look out for it. And I want to really talk to you about the opportunity for investment properties and some of the calculations that you might want to consider if you are looking at an investment property. So apologies, my camera is not working, but that's okay because I'm going to actually share out my screen and show you some elements that need to be calculated. And so that's actually more important than seeing me. So I'm going to show you a couple of different calculators that I use with my clients. So you will better be able to understand when I'm talking about investment properties, how am I going about calculating information so that I can ensure that my clients are comfortable with what they are doing, what it looks like in the immediate run cash flow, and also what you're looking at for return on equity over a longer period of time. My policy when it comes to investment properties has always been a buy and hold philosophy. I know there are people that do flips, and although that's, I think, a great way to make money, every time you purchase a property, there's going to be items that are going to make purchasing a property challenging. If this was easy, everybody would be doing it and we'd all be sitting there celebrating our successes. It's not that easy, and it requires people to sit back and really think about what they want to do when it comes to their investment properties. So that is really the premise for what we are doing, is to have a look at these things. All right, so to get started, when it comes to investment properties, it all depends if you are a purist or more of a, just kind of looking at the numbers from a certain direction. But I use a calculator tool that works both for pre-construction and for resale. So the tool that I use it and I put in all my different properties, all my potential properties. I put them here so that I can flip back and forth and look at the numbers. Now, a while ago, I was looking at some properties in the Dominican Republic. So here's the can of Pearl. I love that project, by the way. Now, this is US dollars, so you do have to do a little bit of conversion. But if you assume everything's US dollars through, then you kind of just have to look at the bottom line for monthly and the bottom line for your overall growth. But here's an example. So this particular property was almost 1350 square feet. It was a 2-bedroom, priced US dollars for 222, which is just under 300 Canadian. I know you're already saying, where can I sign up? This was a couple of years ago now. So I was down there in December of 2018, I think, or 2019. It was a little while ago already. So this particular project may be gone, but to show you how the tool works. So basically I plug in the numbers, the square footage and the price. That will then give me a price per square foot. I know a lot of you like to use price per square foot when you're comparing one property to another. It's not a bad idea at all to consider price per square foot. So at this price per square foot, you know you're not going to be able to find this price per square foot anywhere else. So sometimes I think, wow, that's kind of crazy to even ask what that is. And so then you start putting in numbers like your initial deposit, the deposit that you need for the total down payment, your down payment, and other elements. So you can see I was kind of messing around with this one. So there's a number of things that don't quite make sense on this. But the one element that was kind of interesting is that this particular project would likely be used part-time, casual part-time by myself, and I'd probably be renting it out. And they did have a rental program So when I did some calculations on it, I included the cost of the rental program, which I think it was about 30% would be what it would rent out for. And I was just comparing it because I was able to find some things on Airbnb that also showed what you could rent these properties for. So I kind of had something to compare. They're in the same neighborhood. So I kind of had something to compare, which is good. It's just a little over $1,000 a week for a 2-bedroom. So that's actually not bad per person. If there was, 2 couples in the place or 5 people, it works out per person to be pretty inexpensive. And the fact that you can rent them monthly is also nice. So you can pack up and kind of go and enjoy the sunshine without the worry of ownership if you were looking at the rental portion of it. So certainly there are people that do that. So that's the nice thing about considering all of this. All right, so I'm going to take you over and have a look at a couple of the real ones. So we had a look recently at a property. This one now, January. Yeah, we had a look at a property not too long ago. I think I've got the wrong price in here. I think it was, let's put $769. That's probably a little bit more realistic. No, the floor plan. Sometimes I know I look at different things and I kind of bubble and look at put in the wrong one. But okay, so here's one. So this property is in Hamilton. Hamilton right now is has been for the last few years going through a bit of a renaissance, and it is actually quite good to consider what Hamilton has to offer. So this particular project, in fact, tonight I just got a call from an agent who's selling things in Hamilton as well, and that property is coming on the market very soon. So I'll be able to tell you a little bit more about this. But this one was from February 2019, so a couple of years ago now. The project size, the floor plan was around 1,100 square feet, and the purchase price, which included parking, locker, and upgrades. So the price per square foot came to $627. Now, at the time this one was sold, downtown Toronto, the price per square foot was and still is about double that. And although this has not had the growth that downtown Toronto has, the price per square foot continues to be substantially higher in downtown. So it's something to consider. The down payment required 20% because we're gonna use it as an investment. And so here is what was paid. Here is the mortgage and the mortgage rate. Now at the time, the mortgage rate, that was a really good mortgage rate. Nowadays, if you were to buy, you're getting mortgage rates of, let me put it in as 1.7. So the mortgage rate might be substantially lower, but at the time that was a really good mortgage rate. Now, typically our terms are 5 years, and your amortization, depending on what is offered to you by your lender, is either going to be 25 or 30 years. And it will make a difference to the mortgage payment. So right now the mortgage payment is about $2,200. So if I amortize it over 30 years, that mortgage payment goes down to $1,900 a month, which is pretty good considering the size. Carrying costs, taxes, and monthly maintenance. So the total carrying cost in a month is $2,700. And again, remember, that's for an 1,100 square foot property. So it's pretty big. All right, now for rent, the rental income on that, rent had softened at the time, and there's always changes in the marketplace. So just when you think, yeah, I've got this one, it looks really good and positive and everything's gonna work out fine. Sometimes there are changes in the marketplace, like today, where there are very few tenants. So it is more difficult to rent, and a lot of the rents, especially in the smaller units that are vacant, are sitting there waiting for a tenant, and the prices have softened. But at the time, like this one, if the market was hot or if it was maybe slightly more into the city, would have probably rented for about $3,500, $3,600 a month. But this is Hamilton, so the rent was substantially lower. And as you can see, if we had it for 30-year amortization, it actually would have produced a tiny little cash flow, positive cash flow. But in amortizing it over 25 years, it actually has negative cash flow. Now, sometimes I say to people, negative cash flow isn't always a bad thing. Sometimes negative cash flow means you've got some extra write-offs, which if you're doing this on the side, it could be that this is your side hustle and that your full-time job is your main job. And to balance out the income that you're earning, having a little bit of a loss is not necessarily a bad thing. Now, this is taken as a snapshot at the time you're purchasing. Rents will go up. They will go up every year. So over time, the rent may go up to 20. Well, I'm exaggerating a little bit, but say the rent goes up to $2,850, your losses are less. Say it goes up to $3,000, and your losses are basically negligible. So you can see that as these numbers, as you play around with some of these numbers, you can start to get a feel for perhaps the value of a property. And if there are other reasons why you're purchasing it outside of just the numbers, then playing around with the numbers at least gives you some idea as to what it looks like. So in this case, the rent was a little bit lower, the carrying costs a little bit higher, so it did produce that negative income. Typically, your monthly utilities, your hydro, water, that type of thing, are paid by the tenant. So if it's an investment property, this particular field would be left empty because those are paid by the tenant. So again, this is what I use as my quick calculator to be able to assess certain things. Now, the next element, so this is cash flow basically. So the next element is property capital gains. And every city, every area of a city could have a different percentage. 4% would be considered relatively low. In the city of Toronto, for example, the annual equity growth is about 7%, which means that every year that property is going to go up in value by about 7%, the next year up by 7%. But because this is Hamilton, I wanted to choose a very conservative number, so I chose 4%. What this tells me is that in 10 years, this property, which we paid $688 for, should be worth approximately $837,000. And that means a capital gain of $150,000 approximately. So it's growing from my initial deposit. So I put in, my initial deposit was this amount, 143. So it grew by it basically doubled in value, my initial deposit. So I'm doubling my money. It grew 104%. So it paid me back my money plus an additional 4%. Some of you may say, well, that's good, but I could do better. And that's true. Again, these are what I use to assess information. It doesn't mean that this property is any better than anything else. It depends on what I'm looking for. One of the challenges with buying in Toronto is that many of the properties now are priced so high that it makes the bottom line very difficult to achieve. Your cash flow will likely be negative, but your equity growth is going to be substantially higher. So let's pretend this is Toronto for a second. So for one, we probably can't get it at that price, but let's use these numbers and just calculate forward. The one change that we're going to make is we're going to say that the rent, let's say we can get market rent of about $3,500 a month. So with all these things being the same, and you know they're not because the price per square foot is going to be higher. So let's say that this one is going to be 1,100 is going to be about, let's just say conservatively 1.1 million. Let's make sure I've got enough decimal points. There we go. Okay, perfect. So now it's about 1,000 a square foot, which is still pretty conservative. As you come down, and if taxes are the same, maintenance may be a little higher. In Toronto, it's usually a little higher. Let's say maintenance is going to be $650 a month. So the cost to carry this property in the city of Toronto is going to be about $4,500 a month. If I can get $3,500 a month, I'm losing about $1,000 a month cash flow. Now, for some of you, that may not be a big deal, but where you're going to gain is in that equity growth. So whereas you're losing cash flow, in 10 years, the equity growth on the property at 7% means that property is valued at about 1.55, and we paid, what did we pay? We paid 1.1. So it's gone up over 400,000, almost $450,000. That is almost doubling what I put into it, doubling what I put in. So that's actually not bad. again, it all depends what you're looking for. Are you looking for the longer term horizon, or are you looking for cash flow? If you're looking for cash flow, then you may say that even a condo is not going to cut it for you, because the single door just does not produce the revenue that you're looking for. And you need to look for a property that has perhaps 1 or 2 units in the property. And you may not be able to find those in the city of Toronto. You may have to actually have your realtor hunt a little bit further out. They do exist, but I think you're going to probably have a hard time in the city of Toronto just because our prices are so high. But all you have to do is get out a little bit. Go to Durham. You can go to Hamilton. You can go to Brantford. You can go to Cambridge and Kitchener. And you can find properties there that are pretty good value, price per square foot, and producing a return on equity in a nice amount. All right, so this is what you have left. So again, I showed you on the end of 10 years, this is your growth. Your return on investment, cash flow is going to be negative. Now that assumes that we continue with today's values for 10 years, which is not likely going to happen. Rent will likely increase over that time period. The mortgage and principal paid over 10 years would be this. Your capital gains are this. So your total return when you go to sell this property in 10 years is going to be $622,000, which is a total 10-year cash on cash return of 276%. That's almost 300%, 300 times the cash that you put into it. That is absolutely incredible. And if you take that and annualize it, it works out to be 27.6% per year. And I tell you, can you get those types of returns from putting your money in a savings account? And the answer is obviously no. So these are the types of tools that I use when I help my investor clients decide whether or not purchasing an investment property is for them and what the investment property might look like. Now, these are simple tools. I also have another calculator that I use, which also takes some additional concepts into play. So the second calculator I use is my Investor Quick Calculator. And this also analyzes things like, you know, what am I going to pay for it against the asking price? If it's a bidding war, it kind of shows me some information. My deposit would be calculated. Some of the fields in yellow you would enter, and some of the fields in white get calculated for you. There you go. I've got that. Your mortgage. Now, your mortgage calculation. For the mortgage calculation, this one doesn't calculate. I actually go and check out what the current rates are. So, for example, I may go to PamelaSimons.ca. Why not? And I've got a bunch of tools over here that you can use. So visitor tools, calculators. And so if you're looking for things like land transfer tax, mortgage loan calculator, affordability, or CMHC premium calculator, you can come over and have a look at these. So let me click on calculator. And if the property I'm looking at, I end up paying $450 with a 20% down payment. So the asking price is, or sorry, I end up paying $450 with a 20% down payment. The nice thing about this calculator is it does allow you to do different scenarios. So 5% down, 10% down, 15% down. If you do pay those smaller amounts down, don't forget you have to pay mortgage insurance. 20% starts where you don't have to pay mortgage insurance. So now I've got, oh, by the way, the mortgage insurance premium gets rolled into your mortgage. So it means you have a higher principal amount. And that's kind of nice because you're able to come in and talk a little bit about the fact that you've got just different choices. So that's your mortgage insurance amount. Hey, Keisha.
Hi, how's it going,
Hi.
Pamela?
Good, 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 good. I'm just walking through a demo here. All right, so next, the mortgage calculator, because our rates are so low, 5-year fix. Now, a caution for your mortgage type, the fixed year rate, it's good and bad. The good part of it is that if the interest rate's going to be low. The bad part is you have to keep it for the 5 years, and if you don't, there's an interest penalty for cashing out of that mortgage early. So the interest penalty is thousands of dollars. So my recommendation for people is, if you can, unless you feel totally uncomfortable with it, if you can, choose a variable rate, because if you decide to cash out of the mortgage earlier, the interest penalty is only 3 months interest. So it's like maybe $1,000 penalty versus thousands. Like literally, I was looking at doing that and the penalty was 26,000. That's ridiculous. All right, so that's the mortgage right here. So I can come back to my investor calculator and put my mortgage, which is about $1,250, in my calculator. And so it's kind of showing you some annual numbers. When you are purchasing, the nice thing about this calculator as well is it reminds you of lawyers and expenses, land transfer tax. Again, remember on my calculators, I've got a land transfer tax calculator. So you don't have to guess, you can just come here, plug in the purchase price number, and so it was 450. And it will show you the land transfer tax. So if the property is in Toronto, the land transfer tax is basically double. If you are a first-time home buyer, there is a credit, and so it will reduce the land transfer tax payable. If you're not in the city of Toronto, let's say we're in London, Ontario, it does not have that second land transfer tax. So there's only one, and same thing, if you're a first-time buyer or not, you can just turn that on. Let's assume that we're not. So the land transfer tax is basically $5,500. So we can plug that in here. And so now you'll remember all of these things. So I've got a bunch of different tabs, one for cash flow, which talks about net operating expenses as well, your cap rate, which will calculate for you, and your return on investment. So the cash flow, passive appreciation, which means you did some upgrades, principal recapture as you pay down your mortgage, and passive is just the market growth. Active is if you did renos. And so your annual return on investment with real estate is mega high. So those are the two calculators that I use when I'm calculating what the numbers look like on an investment property. All right, so hey Keisha, I know you've come just at the tail end. I kind of walked through the thing. I didn't have any visitors this evening, so I have nobody to talk to. But I still record the video. I still record the video anyhow, so that I can